A dividend investor's worst nightmare: when one of their companies cuts its dividend. Today we will go over 5 dividend aristocrats that I think will continue to pay and raise their dividends even during this current crisis. Hi everyone, this is Tom from the Dividend Attitude. A lot of dividend stocks have already cut their dividends in the current recession. So how do you prevent getting crushed by one of your dividend stocks cutting their dividends? By looking at the quality of the company and the dividends they pay out. In today's episode we learn how you can quickly analyze the dividend safety of a company. We will take a look at 5 dividend aristocrats. Dividend aristocrats are an elite group of companies who have paid and raised their dividends every year for at least 25 years. After that I will also go over my portfolio to show you I have real skin in the game. Before we start, I also want to quickly thank all of you who have subscribed, commented and liked my videos. It really helps to support and grow my channel. We are on our way to 200 subscribers now, so let's keep that going so more people can enjoy my content. This first pick will probably not surprise many, since they have paid and raised their dividends for 58 years and have recently increased their dividends by 6%. Johnson&Johnson is a healthcare company that is divided into 3 business segments: consumer healthcare products such as skincare, baby care, etc., medical devices for surgery, vision, etc., pharmaceutical products. But why do I think Johnson&Johnson and the other 4 different aristocrats are safe and will continue to pay out our beloved dividends during a recession? First, let's take a look at the criteria I will use to make a quick assessment on the quality of a company and ultimately the safety of the dividends. The criteria I will use are the payout ratio, what is the trend, and based on both earnings per share and based on the free cash flow. I will take a look at the dividend growth rate with a minimum of 5%. And I will take a look at the different growth history. I will take a look at the debt levels. I will take a look at the free cash flow. I will also take a look at the return on equity and the return on invested capital. And I will take a look at the revenue growth. And besides that, I will also take a look at the operating margin, so how efficient they produce their products, what the Simply Safe dividend score is. Getting back to Johnson&Johnson, they have paid and raised their dividends for 58 years now. Their payout ratio based on earnings is a modest 52% and their payout ratio based on free cash flow is 55%. Looking at the payout ratio historically, we can see that it's creeping up a bit, but for a stable company like Johnson&Johnson, a 55% payout ratio is good. What I love about J&J is their consistency. Their dividend growth rate is about 6-7% and it is very stable. The dividend payout graph at the bottom also shows a nice upward trend. According to Simply Safe Dividends, their dividend safety is 99 out of 100. What about the underlying business? How is that performing? I checked their revenue growth and their revenue went from 61.6 billion in 2010 to 82 billion in 2019, resulting in a 3% annual growth rate. For a big company like J&J, that is quite good. I prefer companies that have a low debt to equity ratio, so their current 0.45 debt to equity ratio is within that range as well. It did creep up a bit since 2010, where J&J only had a debt to equity ratio of 0.16, but that is okay. The overall trend of the free cash flow is also showing a nice uptrend. The free cash flow per share went up from $5.02 a share to $7.31 a share in 2019. Also good to note is that Johnson&Johnson is one of only 2 companies who have a AAA credit rating in 2020. Meaning their risk to default on their debt is deemed very low. In fact, Johnson&Johnson even has a better credit rating than the US government itself right now. Their return on equity is 25.36%, meaning for every dollar of equity that is put into the company in equity, they return $1.25 in profits. I like a return on equity above 10%, so 25% is very good. The return on invested capital is 17%. So for every dollar they invest, they return $1.17. The operating margin of 25.5% is also quite good. The way to gauge this is to compare it to their biggest competitors like Abbott Labs with 14.2%, Medtronic with 21.7%, and Pfizer with 26.9%, and Bristol Myers Squibb with 22.6%. So of some of their biggest competitors, only Pfizer has a higher operating margin. If you liked the video so far, don't forget to like the video and subscribe to my channel to help me put out more content like this. This company is one of my favorite holdings. In recent years they have offered a unique mix of a decent current yield of 3% and a double-digit dividend growth in the last couple of years. Rowe Price is a financial services company that provides global investment management services through its subsidiaries to investors worldwide. They offer a scala of products in the form of US mutual funds, sub-advised funds, separately managed accounts, and more. Founded in 1937, T. Rowe Price is one of the world's largest investment managers. T. Rowe Price has increased its dividends for 34 years in a row. Their earnings per share payout ratio is almost 51% and their free cash flow payout ratio is 60%, based on the 2019 free cash flow per share and forward dividend. Their payout ratio has been very stable, hovering around the 50% mark. For a company that has been raising their dividends for 34 years already, they have a very nice 12.2% 10-year dividend growth rate. In fact, their most recent increase was 18%. Again, you can see a very nice upward trend in the dividend payout. The dividend safety score of Simply Safe Dividends stands at 94 out of 100, so very safe as well. A unique thing about T. Rowe Price is that they have almost no debt. In fact, as you can see in the graph, before 2019 they had no debt at all. Their revenue grew 13.3% annually from 2.4 billion in 2010 to 5.6 billion in 2019. Though it should be said that as an investment firm, those years were of course supported by a long bull run in the stock market. The free cash flow went from $2.32 per share in 2010 to $5.99 per share in 2019. Though there was a big dip in 2018, the overall trend is up. T. Rowe Price does not have a credit rating since they have almost no debt. The return on equity is very nice 31.39% and return on invested capital is also very nice at 30.71%. The operating margin of T. Rowe Price stands at 42.49%. Comparing to a competitor like BlackRock with an operating margin of 38.8%, they are doing pretty well. NextEra Energy is a leading clean energy company headquartered in Juno Beach, Florida. NextEra Energy owns two electric companies in Florida. Florida Power and Light Company, which serves more than 5 million customer accounts in Florida and is the largest rate-regulated electric utility in the United States as measured by retail electricity produced and sold. The second company is the Gulf Power Company, which serves more than 460,000 customers in 8 counties throughout northwest Florida. NextEra Energy also owns a competitive energy business, NextEra Energy Resources LLC, which, together with its affiliate entities, is the world's largest generator of renewable energy from the wind and sun and a world leader in battery storage. NextEra Energy has raised its dividend for 26 years now. Like T. Rowe Price, they've also quite an impressive 10-year dividend growth rate of 10.2%, which has even increased more in recent years. Their payout ratio of 61.69% has increased a bit in recent years, but for an utility with a very stable income stream, that is perfectly fine. Again, we see a very nice upward slope in the dividend payout graph. Like Johnson&Johnson, NextEra Energy also has a dividend safety score of 99. For utilities, the free cash flow gives a skewed analysis. And I can show you why by going to the cash flow statement of NextEra Energy. NextEra Energy has a low or negative cash flow because they are spending a lot on acquiring and maintaining new assets. And that is quite common for utilities because they rely on their infrastructure and infrastructure expansion to make money now and in the future. For utilities, there is a difference between capital expenditures for maintaining their network and growing their network. And the growth is often funded with debt with low interest rates. Just check out some of the other utilities like Duke and Southern, which show the same picture. The revenue growth of NextEra Energy is 2.56% annually, and it went from 15.3 billion in 2010 to 19.2 billion in 2019. The current debt to equity ratio of 1.01 would be considered high, but is actually quite normal for an utility. Again, since utilities have such a reliable income stream. Like I previously mentioned, free cash flow is not a good measure to look at for utilities that invest heavily in their future infrastructure. NextEra Energy has a credit rating of Baa1 and a return on equity of 10.59% and a return on capital of 7.54%, which again is in the same region as other utilities like Southern Company and Duke Energy. The operating margin of 26.32% is tad higher compared to the 22.75% of Duke Energy and the 24.81% of Southern Company. As stated on the website of Automatic Data Processing, ADP, We are a comprehensive global provider of cloud-based human capital management solutions that unite HR, payroll, talent, time, tax and benefits administration, and a leader in business outsourcing services, analytics and compliance expertise. Automatic data processing has a dividend growth history of 44 years. I don't know why SeekingAlpha is showing 21 years here. Again, a very nice 10-year growth rate of 10.8% with an accelerating growth rate in the most recent years. The earnings payout ratio stands at 63.57% and the free cash flow payout ratio at 76.1%, which is quite on the high side to be honest. But their payout ratio has actually been decreasing in recent years, so that is a good sign. The upward slope of the annual dividends is also quite visible, again with the acceleration of dividend growth showing as well. Like the other companies, ADP also has a high dividend safety score of 97 out of 100. ADP has grown its revenue from 8.9 billion in 2010 to 14.2 billion in 2019 for a growth rate of almost 6%. Automatic data processing is also a company with a debt to equity ratio of 0.37, again well below the threshold of 0.5. The only thing to note is that they racked up quite some debt in recent years, but as you can also see in the graph, in 2019 it already came down quite a bit. The free cash flow got a nice increase from $2.89 per share in 2010 to $4.78 per share in 2019. That upward trend is also nicely visible in the graph. The credit rating of AA3 is also considered very good. Even more impressive is their return on equity of over 50% and a return on invested capital of 36%. If again compared to competitors in the payslip HR processing space, with SAP at 11% return on equity and a 7.5% return on invested capital, and Oracle at 32.8% return on equity and a 13% return on invested capital, ADP is doing quite well. The operating margin of 21.3% is in line with the 22% of SAP, but a tad on the low side compared to the 35.5% of Oracle. American States Water, AWR, as the name already suggests, is a water utility. American States Water Company has grown significantly since 1929, when original water systems were acquired. Today, American States Water Company is the parent of Golden State Water Company and American States Utility Services, serving over 1 million people in 9 states. American States Water has a dividend growth history of 65 years with a 10-year dividend growth rate of almost 7%, where the recent increases have been higher towards 8 or 9%. The payout ratio of 53.5% is very good for a utility, and looking at recent years it has always been hovering around 50 to 60%. The dividend payout graph is, just like the other four, a nice upward slope. AWR has a dividend safety score of 98 on a scale of 100 according to Simply Safe Dividend. The revenue has grown at 1.75% from 0.4 billion to 0.47 billion in 2019, which is quite normal for a utility. Their debt to equity ratio is at 0.82, which is also good for a utility and has been very stable over the years. Here you can see the same picture concerning the free cash flow as with NextEra Energy. I couldn't find a credit rating on Moody's for HWR though. American States Water has a return on equity of 14.5% and a return on invested capital of almost 9.7%. Comparing that to some of its competitors like California Water Service Group, CWT, with a 8.36% return on equity and a 5.56% return on invested capital, SJW Group with a return on equity of 2.63% and a return on invested capital of 2.25%, and American Waterworks, AWK, with a return on equity of 10.36% and a return on invested capital of 4.12%. That is pretty good. The operating margin of 26.76% is also pretty good. Of the aforementioned competitors, only American Waterworks has a higher operating margin. To keep this video from becoming repetitive, I only selected 5 safe dividend growth companies that have grown their dividends for more than 25 years. But here's a list of companies you might want to take a look at as well. Most have over a 90 dividend safety score on Simply Safe Dividends. PepsiCo, Colgate-Palmolive, Grainger, Lowe's, Clorox, Hormel, General Dynamics, Kimberly-Clark, Stanley Black & Decker, Procter & Gamble, Illinois Toolworks, A.O. Smith Corp, air products and chemicals. So out of all of these discussed companies, which one is your favorite? Let me know in the comments below. Consisting of mainly dividend growth companies, my portfolio now stands at €1,614 and has an unrealized loss of 16.2% and €1,338 in 2020. My portfolio has been hovering around the 7k mark for a bit now. Since the start of the portfolio in 2017, my portfolio has a plus of 24.4%, which is still a 2% difference compared to the S&P 500 mini future benchmark. In the Giro, the portfolio now stands at €1,117. After bringing my average cost of 3M down by purchasing 3 more shares, it is now showing a positive of almost 3%. But more importantly, the first dividends from 3M are about to come into my account. It's always so exciting when the first dividends of a new purchase come in. SKT is still hovering around the minus 60% mark, so I'm curious what the future will hold for them. And now both portfolios combined in Google Sheets shows us that my portfolio is now hovering around break even with a value of 8,743 compared to a cost of 8,742. Including dividends, the change is a positive 8.3% and $726 compared to the cost. If you want to learn more about researching dividend stocks, I have made a series on how to research dividend stocks, which can be found by clicking on the playlist here in the top right corner. Don't forget to subscribe and turn the notification bell on to stay updated on future videos. In the next episode I will discuss why you should embrace the current market volatility and use it to your advantage. Until next time, bye bye!